Blog Talk Radio.
Good afternoon. This is Brian Dooley, CPA's Tax Talk. And today is October 15th. Tax returns are due today. Those of us who file extensions because our returns are so complex are finally over this year's hurdle. And now we have some time to do tax planning. Not for year 2012. I hope you have all done that by now. Great tax planning is done a year in advance, and most often 2 years in advance. So today we're going to talk about some of those so-called loopholes that are used by the wealthy to stay wealthy and keep wealthy. I hope all of you will create wealth through your tax planning. And we're going to look at the use of related entities, primarily corporations. We will talk a little bit about partnerships, but primarily corporations, to allow us to have control over some important features, the timing of income, the types of income, and even if we have income. Now, I work the show with my robot. My robot helps me out a lot. And as you know, those of you who have purchased my book on Amazon, my tax planning looks at today's world of intangible, the virtual world. So let me get my friend Rob the robot. Rob, how are you today?
Brian, I am feeling fine. Thank you.
Well, Rob, I'm going to have you start off and have you look for your notes on selling our home to a related corporation and some of the tax planning achievements. Now, as most of you know, when you sell your primary residence, the first $250,000 of gain is tax-free. If you're married, it's $500,000. And sometimes we are forced to move, and it's not the best market. We like to rent the house out, but we do not want to lose this wonderful tax law that allows us to avoid taxes. And yes, the presidential debates call that a loophole. Anything that's legal that allows you to avoid taxes is what they're referring to as loopholes. Those are the items they want to remove. The loopholes are not gray tax laws. They're the black and white tax laws that we rely upon. But anyway, so many of us, I was like that. I got married, some of you know, 4 years ago, lived in Irvine. House was a little bit too large for me. Moved into my wife's house here in Silverado Canyon. And I had my house with a lot of gain in it. So what kind of tax planning would Rob the robot have if I wanted to use my related corporation? Rob, can you find your notes?
Okay. Let me find my notes. Yes. When a taxpayer wants to sell his or her principal residence, and that taxpayer is also the sole owner of a C or S corporation, selling the residence to the corporation offer 3 benefits. 1. Cash may be taken out of the corporation tax-free instead of as dividends. This is because the gain on the sale of a principal residence is excluded from income in an amount not to exceed $250,000 and $500,000 for a joint return. And Brian, generally, gain on the sale of a principal residence in excess of the exclusion amount is capital gain. However, some tax advisors believe that the related party rules is taxed as ordinary income. Since money taken out of a C corporation is generally taxable as dividend income, this approach lets taxpayers remove money from the corporation free of tax. 2. Assuming the corporation turns around and rents the residence, the corporation has a cost basis equal to the appreciated value of the house and, thus, bigger depreciation deductions than the taxpayer would have had if he or she held on to the house and rented it. If the corporation is an S corporation, larger depreciation deductions flow through to the shareholders, enabling them to shelter a bigger portion of the rental income that will also flow through. 3. The taxpayer retains control over the residence along with the right to future appreciation. This may be important if the taxpayer thinks the property will substantially appreciate in the future.
Great, Rob. And unfortunately, we all have this hope that our houses will start to appreciate, that we have hit the bottom of the Great Recession. Not all of us have a corporation pre-established. That was my case. When I got married, I did not have a corporation. I was not working in corporate form. Many of us are working in the new preferred structure called a limited liability company. Not as much paperwork to maintain as a corporation, a lot more flexible to some aspects, but that flexibility has a problem. The problem is a limited liability company, also known as an LLC, doesn't always exist for tax law. So a single member of his one owned by one person LLC is considered as non-existing. The tax term is disregarded. Partnerships have had a long battle starting in the late 1940s with court cases all over the place. The point of the 1954 Tax Act, which is what we have now, was to remove all those court cases. So the statute on partnerships treats it a little bit like a corporation and a little bit like two or more sole proprietors getting together. So back to the home sale. Can I do this with a partnership? That is a great question. And it's the type of question that depends a lot upon who the partner is, what's going on in the partnership, and the attitude of the IRS. This last decade, the attitude of the IRS has been the old-fashioned law from the 40s, which is a partnership is a bunch of self-employed people, and each person is allocated his or her income as though it does not exist. We're going to get into that a little bit more as Rob goes into some of the features of S corporations versus partnership. So the corporation has a little bit of magic. A C corporation, and when we say C, we're talking about the chapter of the Internal Revenue Code. The tax code has chapters in it, and then those chapters have a subchapter. So taxation of corporation is found in subchapter C of chapter 1. And corporations are strictly a separate entity. Most of you know that. You can get taxed twice, and that is why since 1960 we have had what's called a S corporation. And yes, that is found in subchapter S. And with the S corporation, you get taxed a little bit like a partnership. The income passes right through. But unlike the partnership, you are clearly a separate legal entity. So kind of the ideal planning to avoid double taxation is to sell your home to a corporation tax on the subchapter S. If I own all the stock, I really have kind of what the old IRS would call an economic sham. Economically, everything's the same. I own my house before, I own my house afterwards, I have all the appreciation. I just saved tax on $500,000, and better yet, my corporation gets that new cost for its depreciation. It's a double whammy in tax savings. That's the easy way to create some wealth. So, how's the IRS going to feel about it? They're going to feel just fine because they've been in court on it and they've lost this topic. So it's the kind of thing you can go for an IRS ruling if you want to have really great tax planning, which is what I always suggest. And now I want Rob to talk a little bit about trying to get an S corporation to have some of the flexibility of a partnership. And it is a item that is used a lot in family planning. So, Rob, can you help us out here?
Yes. I have some great thoughts. One of the differences between S corporations and partnerships is that only partnerships may specially allocate gains, losses, credits, income, and deductions. This is generally seen as a disadvantage to electing S corporation status. However, it does not have to be. There are ways around the restrictions on special allocations to S corporation shareholders. The following are some solutions to consider. 1. Carefully hone the capital structure of the S corporation to capitalize the corporation with debt and equity in such a manner as to tilt the debt component in favor of shareholders who want a stable return. A small risk exists if the corporation is too thinly capitalized. The debt may be recast as equity with the result that there are two classes of stock and loss of S corporation status. 2. Have deferred compensation arrangements that reward employees or others with additional income. For example, an executive can be issued stock options that are exercisable at a bargain rate if the corporation increases its net income over a certain % per year for, say, 3 years out of 4. 3. Form another S corporation and make the two S corporations members of a partnership, which itself makes special allocations pursuant to Code Section 704B, 2, with the partnership running the business. Or have the S corporation shareholders that want special allocations be the partners with the S corporation in the partnership. This can also be used in an estate planning context with the S corporation being the general partner and the heirs being the limited partners. Or there could be a joint venture between the testator's S corporation and one or more S corporations or partnerships that the heirs own. The heirs or their corporations typically contribute cash and get a volatile interest. The testator contributes operating assets and gets a preferential allocation.
Well, that is a lot of choices, and that's the key to great tax planning. It's nice that I present these to you. You can replay this, of course, through either Blog Talk or on my website by calling in to listen to it. But the key here is you look at all these choices, and your tax team works with you, because tax planning should not restrict your creation of wealth. So often I see that it is restrictive. And you want to see all the options, think about not just what you need today, but what's going to happen in the future if there is another recession, or if we should go into stagflation like we did back in the late 70s and early 80s. Is this structure going to keep you from creating more wealth? Because creating wealth is the goal, and it's not just saving taxes, and so often that is missed. Now, quite often, there's more than just a home that has appreciated in value that we want to change, we want to do some tax savings with. And in real estate, it's quite often known as a tax-free exchange. Part of the problem is that you have a buyer for your property, but you don't know what you want to buy just yet. So you're kind of stuck. Now, some people have done deferred exchanges. Sounds good. You pay a fee to a company. Quite often they are a title insurance company or an escrow company. And if they dot all the I's perfectly, cross all the T's, you're going to get your tax deferral. Maybe 1/4 the time they screw up and you get wiped out tax-wise. That's not as bad as what happens some other time. So Lawyers Title Insurance Company was a very famous insurance company, was very big, one of the Fortune 500. About 5 years ago, they disappeared over Thanksgiving. And I was kind of surprised that Morningstar, which rates public companies, had given them such a high rating. And what happened is that they took in lots of money, millions and millions of money on tax-deferred exchanges. And most of you are not aware that unless you have done a lot of work, those funds go into the general operating account of the company. They're not insured by the government. They're not guaranteed. They're not even segregated. Lawyers Title decided to go to some high-risk reverse debt instruments. Lost it all. Lost every penny. Gone. Lawyers Title went under, went bankrupt. And all those people with those deferred exchanges in the escrow accounts lost all the money. and it gets worse, I'm afraid so. They owe tax. They lost all the principal, probably a capital loss, and they owe tax because they did not complete the exchange, not a capital gain to offset that loss. For most people, there's recapture depreciation. And it is not a good position. And actually, it gets a bit worse because the loss and the income are in different years. The loss is in the year that they went bankrupt, and the gain is in the year that you sold the property. And because it was deferred, it could be in different periods of time. So the ideal plan just gets the control over it. And I had Rob do some research on it. Rob, can you find your notes on this?
Oh, let me find my notes. Here they are. For an exchange of property between related persons to be afforded non-recognition treatment, a special holding period requirement must be met. If an exchange of property that would otherwise be eligible for the non-recognition of gain or loss is made between parties that are related, both the property that was relinquished and the property that was received must be held by the respective party for a period of 2 years after the date of the last transfer that was a part of the exchange. Now, when either of the parties disposes of such property within the 2-year period, non-recognition treatment for the exchange will not apply. The gain or loss recognized must be taken into account as of the date of the disqualifying disposition of the property.
So you have a 2-year period that you have to keep the property received so that the tax code gives you bona fide economic substance. In many regulations, the IRS puts in a waiting period. Sometimes it's 2 years, sometimes it's 5, sometimes it's 7. And the theory is that when you pass that 2-year period of time, you have objectively proved that the transaction was not tax motivated. Because if you do any transaction with the only purpose of saving taxes, even if it follows the statute perfectly, the IRS can disallow it. It is a common law, which means a case law doctrine, which means a rule that overrides the tax code. So this was a lot to go over. I encourage you all to play this again, take some notes, and work with your CPA and attorney. If you want to have a great tax team like Mitt Romney, and as you know, I have a broadcast on his tax planning, you have to be the leader. You have to encourage your team to use some of these tools. So until next time, I wish you all great planning. I'm glad tax season is finished. I can go out and play. I wish you all a great day.